We're finally halfway through the year, and it has been an absolute roller coaster ride of ups and downs for the market. Some investors have very mixed feelings about what is going to come in the future, but we're going to stick to the fundamentals, and that's exactly what we're going to be covering in this video. Now, when we start looking at the S&P 500, it has surged more than 20% between April and June. So we have seen all of the losses that we had for 2025 actually come back, and we're positive so far for this year. Now, of course, that could change in an instant. Thinking of tariff policies, thinking of everything going in the government, even looking at the government and the Federal Reserve, this could change when it comes to the future. But when we start looking and thinking of longer term, we're talking 5, 10, 15, possibly even 20, 30, 40 years out. When it comes to longtime investor Warren Buffett, he has timeless advice to really follow. And I have followed this for a multitude of years now and been incredibly successful. So when we start looking at the 3 tips to perfect your portfolio while really maximizing everything that you can invest in. Number 1, be greedy when others are fearful. This is one of the best tips when we start thinking of volatility, when we start thinking about the ups and downs of the market. Think about it for a minute. Be greedy when others are fearful. Right now in the market, there is a lot of fear. There's a lot of fear that we're seeing. This advice, of course, given in a 2008 opinion piece for the New York Times when they were thinking about the Great Recession in the housing market and all of the fear that was going on. And even looking today, the fear meter is pretty high with everything we have going on overseas with Israel and all the other everything that's kind of happening over there. A lot of uncertainty in the market and a lot of fear when it comes to the market. Now, he explains that when investors should be very cautious of weak companies, but there's no reason to have any fear at all when you look at investing in strong businesses. For businesses, there will be hiccups, there will be adjustments. There have always been since the beginning of time, but most major companies will have record profits within 5, 10, 20 years from now. And when he said this in 2008, since then the S&P 500 is up 535%. So if you think about it, when you look at really building wealth and wealth generation, it is about investing on a consistent basis over an extraordinary amount of time. So if you think about, let's say you put $500 in the S&P 500 over a 40-year time frame, which for a majority of people is a very large, very absorbent time frame. But when you look at that, you're looking at about a $1.1, $1.2 million with keeping that exact same investment. Now, when we start looking at the market, and when he said this in 2008, the market was absolutely bottoming out. Anyone who rode out the storm and really continued buying as the market went down, that's the exact same advice that I used in 2022 to have my portfolio within the last 4 years, 21 all the way to 25, already up 100% within the portfolio. Best opportunity to be greedy is when you see that market declining and not waiting to find exactly where that bottom is going to be, because timing the market is pretty much impossible. So as we get into number 2, don't be a stock picker, be a business picker. It's not enough to invest in a bunch of stocks and hope for the best. You have to invest your money in the right place. Now, when we look at the annual report back in 2021, this is exactly what he said. And of course, this was at the time when the business partner Charlie Munger was around. We own stocks based on our expectation of the long-term business model that they possess, not because we think that really timing the vehicles and making the moves in the market. It's crucial, not stock pickers, but we are business pickers. Now, for me, I only invest in ETFs or exchange traded funds. This is a basket of stocks. When you start looking at individual stocks, we're talking about, looking at Berkshire Hathaway, looking at, Nvidia, thinking of Apple, thinking of Google. Buying and investing into one very, very specific stock can be good and can have some decent returns, but there can also be a very strong and a very volatile downside, especially if you do see a point where there is negative publicity, negative news, they miss the earnings. You could see a 5, 10, 15% drop in one specific stock. That is where I invest again in those ETFs, and I invest in the market itself. When we start thinking about the broader index, we're talking about the S&P 500, the NASDAQ 100, and a few other markets. When you're investing in something like the S&P 500, you are investing in the 500 largest companies within the United States. So if, again, kind of playing the odds, let's say 50, 60, 70% of those companies are profitable, they have the ability, especially when these larger tech companies, to absolutely carry the market in the entirety. Even if you have some companies that go belly up, if you have some that get bought out, like we've seen with Capital One and Discover that are removed, or essentially Discover removed from the S&P 500, other companies are there to replace them. And even if you have some companies that are not as profitable, a lot of the majority of the larger companies will replace and will carry the market. When we start thinking about the S&P 500 and really getting those above average returns 10%, 10.4%, I believe is still average with the S&P 500. Even when you look at businesses that are struggling with economic instability or a lot of things within the market affected by tariffs, companies are still strong, and companies within the US space do incredibly well. Even in a downturn where we see the market pull, there are still going to be companies in there that do incredibly well when it comes to performance. And the final one, which is a huge piece of advice: if you wait for the robins, spring will be over. It's tempting to wait to put your money in the market. You're looking for a specific point, you're looking for an entrance point, looking at the volatility. And according to Warren Buffett, waiting too long can be and do more harm that can actually do good. So when you start thinking about the market, and we're going to use the most recent downside, which we've seen earlier this year. So as the market started trending down, a lot of people cashed out of the market. I got a lot of comments over on YouTube. A lot of people were out of the market. They sold their portfolio, they sold their position when the market started going down. The market continued down for a little bit longer, and then it started rebounding, and we seen 9 positive days that really brought back a lot of the market in a big way. Unfortunately, for a majority of those investors, they were not invested. Their money was already pulled out of the market. They didn't have anything in the market at that time. So even though they missed some of that downside, they missed the upside in its entirety. That is the reason why when we start thinking about investing, we are talking a 5+ time, really time frame. You can't predict when the short-term movements of the stock market, when we're going to see it. Do you have the faintest idea? Can you predict the future? Absolutely not. We don't know where the market's going to be, higher or lower, over the course of, the next 1, 2, 3 years. When you start looking at that 5, 10, 20, 30, 40-year horizon, chances are, since we've seen this through all of history, that the market has always improved and the market has always went up. During the Great Recession, the S&P 500 reached a low point in March of 2009, but the recession didn't end until June of that year. So again, looking at March to June, in those 3 months alone, the index surged close to 40%. So again, thinking of 2009, thinking of the housing market, if you started selling when the market declined, 3 months, the market went up 40% in the S&P 500, which is kind of crazy for a really big rebound. If at that point you stopped buying, again, buying when people are fearful, buying when, think of the fundamentals, always go back to the fundamentals. One of the best ways to earn and really be consistent within the stock market is investing on a consistent manner. This is dollar cost averaging. This is exactly what I do. So every single Monday morning, dollar cost averaging, I put $250 into the market. So we're putting $1,000 a month, which does not include 401k contributions, doesn't include anything but we have from a taxable brokerage account. Putting the $1,000 in there every single month consistently over the last 5 years has grown the portfolio to about 250,000 as it sits right now. So nobody knows what is coming in the next coming weeks, but I know if you invest in a very consistently investing over an extended amount of time, you will do incredibly well with the market. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.